Hello everyone. I just want to quickly record this video for all my students who are taking managerial accounting. I know this has been a great topic to start the managerial accounting, and I wanted to make sure that everybody is able to understand the income statement that's being prepared for contribution margin purposes, and we also call this financial statement as a variable income statement as well. So this video is primarily focused on looking at the difference between the traditional financial statement that you see on my screen versus an income statement that's prepared only by management for internal reporting, and we call them as a contribution margin income statement. So to understand this statement better, you wanted to make sure that you understand the difference between a variable costing and a fixed costing as well. So differentiating between variable cost and a fixed costing is another topic to discuss. But at this time, I assume that you understand the main or the key difference between variable cost and a fixed cost before we get into the comparison of the traditional versus a contribution margin statement. A variable cost is a cost that fluctuate as the production increases. As the output of a per unit basis increases, the variable cost in a total increases with the same proportionate. And if on a per unit basis, this particular cost, the variable cost, remain constant. It doesn't matter that variable cost is a manufacturing cost or a non-manufacturing cost. What it matters is that is it a variable cost which varies with the unit that you're producing, or is based on the activity that you're looking at. Whereas on the other side, the fixed cost is something that remain constant as a total amount. So in this case, when we look at the fixed cost, any cost doesn't matter if manufacturing overhead or a non-manufacturing expenses, anything that's fixed in nature as a total, we will list them at the bottom and we call them as a fixed expense. So in that case, we're going to assume any cost that remain fixed regardless of the outcome of the activity or the unit. They are considered to be a fixed, whereas on a per unit basis they will reduce because the same cost that you have, you'll allocate between the more units. So in that case, if the output is increasing, we're going to assume the per unit will reduce because the same cost will be allocated to more products. Okay, so again, if you want to read more or get more understanding on that, I refer you to you look at your textbook, or look at some of the other videos that's available. I may create a separate video to differentiate that as well. Okay, so now coming back to the main topic for this particular video is what is my traditional income statement. So if you have done financial accounting, an income statement is required. You're required to prepare a financial statements at the end of the fiscal period. That's mandatory, regardless of whether is a small business or a public traded company. You're required to prepare an income statement based on either the IFRS or based on the accounting standards of private entities. So that particular statement looks like this, the one that you see on my left hand side here. So you put the name of the company, the income statement, you mention the period, which is same as for the management purposes as well. Then you start with the revenue. So typically what happened is we list all the revenues for the corporation that will go right here as a total amount. So in this example, we have a company that has a sale of $1 million. Then what we do is in the next part, so again, this example, we are assuming this is a manufacturing company. So they manufacture the product and then they calculate the cost of goods sold. Okay. You at this time you should understand, or you know how to calculate the cost of goods sold. So what we're doing is we're simply looking at the cost of goods sold as an amount, take that total amount and put them right here. Okay. So taking the revenue, the sales minus the cost of goods sold is going to give me my gross margin. And after I take the gross margin, the next category I have is my operating expenses. So as a company, this operating expenses, you may have a list of various expenses. Okay. So we put them into two major categories, selling and admin. Okay. We can forget about the admin because we kind of group them together. Selling and admin expenses. So selling expenses, anything related to the marketing, admin expenses, any other expenses that you need to run the business. That includes any non-manufacturing expense, which includes your rent for the place, office supplies, insurance for the office, all the other expenses. You list them all together right here. So in this case, we only talks about the total. So we take the total amount of the selling and admin expenses, which is 290,000. So you add everything together, that's your total operating expenses, which is 290, and then we get a final number, which is the net operating income. So to get the net operating income, all we're doing is taking gross margin minus your operating expenses. So this is something that would have been done for financial statement purposes, a financial statement or income statement that's prepared for external purposes. Okay. Okay, so the next part is that we are required to prepare an income statement. So not this particular income statement or contribution margin is not mandatory. So what management does is they prepare this financial statement just for internal reporting purposes to understand what's company's contribution margin, and that contribution margin, if you look at it, is contributing towards covering up your fixed costs. After you cover up your fixed costs, anything remaining will become your operating income or your profit that will be distributed to the owner. Okay. So with this kind of financial statement, you should able to understand that by looking at the contribution margin, you will see how much each product, right, on a per unit basis is contributing to the company. So to do the income statement for contribution margin, we need to look at is from each of these expenses that are given, the cost of goods sold, selling and admin, we need to identify out of this which one are my variable costs. So you list all the variable costs first. Okay, and then anything that's fixed, regardless of whether it's manufacturing or non-manufacturing, we list them at the bottom. So if we were to think about the format of the income statement for contribution margin, we start with the sales. Okay, that's your first line item at the total. So you put the total amount and you were given how many units were sold for that month, and that will help you to understand the sale price per unit basis. Then we will look at the variable cost. So you need to look at the variable cost for every single element that you have in the expenses and categorize them your cost of goods sold and other variable expenses. You can identify per unit basis and then multiply by the units you produce, and that will give you your total variable cost for the cost of goods sold. Okay. Once you identify all the variable costs, the next part you do is calculate the contribution margin. So this contribution margin will be sales minus the variable cost, and then take that amount and divide it by the number of units, give you contribution margin per unit. Okay. And then after you have that, we don't care much about the per unit because this cost is going to remain constant as a total. So we're going to look at the example, identify the fixed cost, okay, and list them here. And we know that this particular item that you have at the bottom, it remains same regardless of how many units you're going to have. You can calculate per unit if you want to, but that per unit is not relevant for any other scenario we may look at, right? But for this situation, we look at this is your total contribution margin, then we go to look at the fixed cost, and then here when we calculate the operating expense income, we take the contribution margin out minus your fixed cost. Okay. So now what I'm going to do is I'm going to show you guys this example. That's if you're using the McGraw test book, this is an example that I'm going to complete, which is exercise or problem 312. Okay, so this example, what we're looking at is we're looking at an income statement that's given, which I just prepared on our Excel sheet as well. This is what they provided me. But to do my income statement from a contribution margin, I need to dig in and identify. They're saying here the cost of goods sold is 40,000 units, $16 per unit. But my question is that is this all variable, or is it all fixed, or is it mix of variable and fixed? Okay, I don't know anything as of yet, but I'm able to find that when I read the rest of the information. And the same thing that I'm going to ask is that this selling and admin I was 290, is it all fixed, is it all variable, or is it all mix of variable and fixed costs? So now what I'm going to do is I'm going to read the rest of the question. Says the company's selling and admin expense consists of 210,000 per year in a fixed expense. You see that they gave me 290,000. Out of that, 210,000 is my fixed cost. So what I'm going to do is any information they are giving me, I'm going to take that information and put it here. So instead of others, I'm going to call them is selling and admin. So they're telling me my selling and admin fix is 210,000. So here I'm going to put is 210,000, and $2 per unit is my variable. Even if they don't tell me that, or all I can do is 290,000 minus 210, the 80,000 is my variable cost. But they told me that $2 per unit also something they gave me, and I have to make sure that when I add both variable and fixed, that should equals to that. So $2 per unit. Okay, so here I'm going to put that in the bracket here is 40,000 units. Okay, because you need to know that whenever you're doing the contribution margin income statement, this particular statement that you're working on is based on how many units. So here I'm going to copy this selling and admin again, and now what I'm doing is I'm putting the selling and admin the variable cost. So variable cost is $2 per unit. So now if I were to calculate the total, I take 40,000 is my number of units, multiply by 2, that is 80,000 units. Okay, so that's my selling and admin. Okay, so that means I've taken care of $290,000. So next question is the 640,000. Then they say that the $16 per unit given above is computed as follows. Direct material $5 per unit. Direct labor is $6 per unit. The variable overhead, so you know that when you look at the cost of goods sold or cost of goods manufactured, it consists of three things: direct material, direct labor, and manufacturing overhead. So in this case, my manufacturing overhead is $5. That's variable. Direct material is variable. Direct labor is $6. That's variable. Overhead is, this is variable overhead. So technically what they did, they took the variable, separate variable and fixed. So this three items that I have at the top, they are variable, and this is fixed, $160,000. So if I look at the fixed overhead, and I'm going to look that fixed overhead is here, the cost of sales, and I can in a bracket and call that fixed overhead, and they told me that this is 160,000. You can list per unit if you want to. We'll list everything as a per unit after on this fixed one. So this is my fixed portion, and then my variable is 5 plus 6 is 11 plus 1 is 12. So the variable cost is 12 per unit. So that means I can put 12 here, and now to get this amount I need to do is 40,000, because that's my output, and I multiply by 12. So that's 480,000. Okay, and obviously we need to put the sales amount which was given to us already. But even if you go back here, your selling is $25 per unit. So I can simply take that as 40,000 times 25, and that is 25 per unit. Okay, so that's my sales for that period. Okay, so now I know that the company's sale is $1 million, which is $25 per unit. My contribution margin is sales minus my variable cost. I take these two things out, so it is 440,000. So now I also need to do a contribution margin per unit. So that one also taking my sales minus my variable cost is 12 plus 2 is 14. So I take both of these things out. That gives me my contribution margin per unit. So now this company, Whiteman Company, we know that the company has a contribution margin of 440,000 or we can state that the contribution margin for the company is $11 per unit. So that means every time company make a sale, it will contribute $11 to cover the cost and also to cover your profit that will be distributed to the shareholder. Then the next part is my fixed cost. The fixed cost never changes, so that means these amounts are going to remain same regardless of how many units we sell. So just to get the per unit for the company, we'll just take that divided by $40,000. Okay, and that's $4 per unit, and then this one will take 210,000 divided by 40,000 as well, and that is $5.25. So now to calculate the operating income, what we do is we take the contribution margin minus fixed cost. Okay, you can create a total here if you want and do the same thing under the variable cost as well. You can add them together, but this is small example, so I'm okay to list them, but then you're gonna have to make sure you subtract all the fixed costs. So now we see that this is my operating income. So now what is my operating income per unit? I take the contribution margin out, take away my fixed cost, is operating income is $1.75. To me, these guys are not relevant. Okay, I can get rid of this up. This is not providing any valuable information. The only thing that's valuable is the contribution margin per unit for my future analysis. Okay, so in this example, after you finish this, you have to read this financial statement as the company has a contribution margin of 440,000 with 40,000 units. So that means the company contribution margin is $11 per unit. So now with that being said, even if I don't give you this amount and you already know that this $11 per unit is your contribution margin, you can simply take that multiply by 40,000. You should able to determine the contribution margin regardless of the information that's given with your sales, cost of goods sold, and selling and admin. Okay, and this piece here remain constant on a total amount. So the bottom line here is that why do the the management prepare this statement? So the purpose here is to understand company's contribution margin ratio. Okay, so that way in the future, if they wanted to estimate to increase or decrease the production, they can understand whether the company will able to survive with the new production level or the company will skyrocket or go up with the new units that the company is going to produce. Okay, so it does help the company for budgeting purposes and also to expand the operations as well, and then also predict if something going wrong is going in the economy, and then they wanted to look at the target sales they have to do to cover the fixed cost and also to get a minimum profit the company wants. These statements comes handy for that analysis. The other point that I also like to point out here, but obviously when you do more example you'll understand that, and also some of the other chapters that you're going to do, is when you look at the contribution margin, this particular statement we're looking at is looking at the average sale price and average variable cost. But when the companies look at this kind of financial statements, they do these for every single product that company is making. Or if the company has different divisions, they wanted to analyze what is the contribution margin for each of the product that they run or they make in the company. So they calculate the contribution margin on a per unit basis for all the different products they're producing. Okay, and then in the future, if they wanted to reduce the production, then they obviously will pick the one that has a lower capacity. Okay, so this typically gives you a good understanding on your analysis on the income statement. The next part that I want to show you guys in this particular example is the analysis as how do we use this for our future purposes or future analysis. To use that, so we're looking at the same example, and now what we're doing is we're trying to look at from the prospect of if the company increase or decrease the production the next year, how does this impact the company? So they ask us to look at the two different scenarios. Okay, and the first scenario they say is what would the operating income if only 32,000 units were sold in the year. You can assume no change in the fixed cost, fixed expenses will incur, and if sales declines to 20,000, okay, so then we're going to have to look at that is that we assume there is no change in the fixed cost, and what happened if the sales declines to 20,000. Okay, and always remember that when you're doing these situations, you don't need to do the full income statement. I'm going to show you guys this in this particular Excel sheet that I have, and I'll share this one with you if you're enrolled, if you are on my course, and then I'll be able to post that on your Blackboard site so you can understand the relationship. So in this example, we know that the contribution margin is $11 per unit. So without doing any calculation, okay, so what I'm going to do is I'm going to calculate here is my contribution margin, okay, using 32,000 units. Okay, and I'll fill up the rest of the information, sales, variable cost later, but I want to do the calculation just to contribution margin. So you see that the contribution margin per unit is $11. So if I were to calculate how much is my contribution margin if my sales is 32,000, all I have to do is take 32,000 multiply by $11 per unit. So I know my new contribution margin is 52,000. Okay. So what I'm going to do here is I'm going to draw a line here just to see my total fixed cost. Okay. So this is my total fixed cost. Okay, so I'm going to put here is total fixed cost. So now the company has a fixed cost of 270,000. So if the company reduces its production or the sale is gone down to 32,000, the company is only going to have a contribution margin of 350,000. And what happened with the fixed cost? The fixed costs remain the same. Okay, so if my fixed costs remain same and my contribution margin is only 352,000, guess what happened? That means I'm going to have a net loss of 18,000. So in this case, see this here, the contribution margin is not enough to cover my fixed costs. So if it is not enough to cover my fixed costs, what happened to the company? The company will have a net loss of $18,000. Okay, and now if you were to do this full statement, you can just take a million for 32,000 multiplied by $25 to get the revenue, and the variable cost you can simply take 32,000 times 12 times 2 and then subtract that out from the revenue. That will be your contribution margin. Okay, so to take a shortcut, anytime they give you they want you to do analysis, all you have to do is take the contribution margin per unit, multiply by the number of units that you have based on the new scenario, and take away the fixed cost. Okay, and then in this case fixed costs remain same. Okay, so now think about in this case, if you were to ask by a manager, say, okay, well, what is my fixed, how much money I have to get to a break even? I have to tell them, okay, I need to make sure I have a 370,000 of contribution margin to cover the fixed cost and still able to survive and have a zero profit. But in this case, anytime you have a contribution margin less than 370,000, you are going to be at a net loss position. Okay. So the second situation they ask me is you can assume no change to your fixed cost will occur if sales decline to 20,000. Okay, so in this case they are asking you, say you can assume no change in the fixed cost will occur if sales declines to 20,000. So we already know that now with the decrease of the sale from 40,000 to 32,000, we are already in a net loss position. So here the question is that if the sale declined to 20,000, so now the 40,000 sales declines by 20,000 unit, what will happen to the company. Okay, the same concept goes there as well, that you are going to do another scenario, but in this case you are going to have is your contribution margin will be 20,000 times 11, that is your contribution margin. And then looking at the fixed cost, you can simply, because the fixed cost remains same, so therefore my sale, I'm going to have a net loss of $150,000. So you see that as the sale decreases, your contribution margin remains same on a constant basis, but on the other side your variable cost will obviously decrease. If you were to do this analysis, right, and we'll show you, this is not something that you have to do, but if you see that this $25 will remain same on a per unit basis. Okay, so I'm just going to list the per unit here. So 25, or we don't need to list per unit, all we need to do is just take 25 times 32,000, because the good thing is that the variable cost per unit will remain same. All we need to do is just take that number, multiply by the new production or the new sales. Okay, so I times it by $2 times by 32,000. Okay, and then if you do this minus this, you will get the exact amount that I have here. Okay, and then you can do the same thing here as well, that you can take this number, multiply by 20,000 units. Okay, so in this case you can just put this formula because it does the same thing. I will copy paste. Okay, you see that now I just take $2 times 20,000 unit, and these guys remain same as a dollar amount, so we don't need to change that. So you see that as the production decreases, the variable cost decreases with the same proportion. Okay, and then eventually the losses will keep increasing. And then if it goes in the other direction, that if your sales are increased by $40,000, you will know that your contribution margin, your operating income will increase by $11 per unit. Okay, but if you go downwards, you know that your operating losses or your operating income will go down by $11 per unit. Okay, so if you were to do this way, you can do that on a per unit basis. The other way, if you were to say, okay, well, what is my new net income? All you have to do is find the new contribution margin and then take out your fixed cost. Okay, if they simply ask you what is my change in the operating income, you can simply take that, see that sales decreased by 8,000. 8,000 times 11 is your $88,000. So that means we know that the sales will, or the operating income will decrease by 88,000. Okay, so you can simply just take whatever the decrease, in this case 32,000 minus 40, which is 8,000 per unit, and my contribution margin was 11. So as sale decreased, my profit is going to decrease by $11 as well. So now you see that my decrease in the net operating income is 88,000, which is exactly the difference between these two guys here. And the same thing you can do that is with this. If your sale decreased by 20,000, okay, now you're going to see that your contribution margin is 11. So 11 times 20,000 is $220,000. So you see that your operating income went down by $220,000. Okay, so you see that how this helps the management to do the analysis for future. So I hope this will clarify a lot of things regarding the difference of contribution margin statement versus a traditional financial statement. And obviously the more practice you do, the better you will get on this as well. This was an example where you're given the group of expenses, but there may be a situation where you're not given only one expense but a multiple expenses, and then in that case all you have to do is just list them here, right? And then at the end add all the variable expenses. And that will be the only difference between a simple question versus a more complex question in this particular statement. Okay, so this will be it for this particular video, but if there's more topic that I feel that you need that are important, I'll definitely will discuss and create a video and then share that with you guys. Take care everyone. Bye for now.